This week, Federal Reserve Chair Jerome Powell issued a warning that could directly affect your wallet. He says the tariffs might push prices up while slowing the economy down at the same time. That's a rare and difficult situation, and the Fed isn't used to dealing with both problems at once. So what does that actually mean for you, your money, and your future? Let's break it down.
The level of tariff increases announced so far is significantly larger than anticipated, and the same is likely to be true of the economic effects, which will include higher inflation and slower growth. Both survey and market-based measures of near-term inflation expectations have moved up significantly, with survey participants pointing to tariffs. Survey measures of longer-term inflation expectations, for the most part, appear to remain well anchored as well. Market-based break-evens continue to run close to 2%. So, as we gain a better understanding of the policy changes, we'll have a better sense of the implications for the economy and hence for monetary policy. Tariffs are highly likely to generate at least a temporary rise in inflation. The inflationary effects could also be more persistent. Avoiding that outcome will depend on the size of the effects, on how long it takes for them to pass through fully to prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to make certain that a one-time increase in the price level does not become an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close.
So, Powell said the tariffs are larger than expected, and that could put upward pressure on prices, meaning everyday goods like food, gas, and household items could get more expensive. At the same time, the overall economy might begin to slow down. That could mean fewer job opportunities, slower business growth, and less consumer spending. When inflation rises while the economy slows, it's called stagflation, and it's one of the most difficult challenges for the Federal Reserve to manage. Normally, if the economy is slowing down, the Fed lowers interest rates to encourage borrowing and spending. That helps businesses grow and creates more jobs. But if inflation is also rising, lowering interest rates can make the problem worse, because it gives people more money to spend, which can drive prices even higher. On the other hand, if the Fed raises interest rates to fight inflation, it could slow the economy down even more by making it harder for people and businesses to borrow money and invest. That's why Powell called it a challenging scenario. The usual tools the Fed uses to keep the economy stable may not be as effective if both problems hit at the same time. Now let's be real, this is about strategy. Trump's tariffs are meant to protect American jobs and bring back manufacturing, but the Fed's job is different. It has to keep inflation low and employment high, so it's not about who's right or wrong, it's about how these two agendas collide. If prices go up and growth slows down, it could hit the markets hard. That's why Powell's comments matter, not just for Wall Street, but for everyday Americans trying to save money, invest, and keep their job secure. If you're new here, we make complex economic news easy to understand. No jargon, no nonsense, just real talk about how it affects you, so hit subscribe and tap the bell, because this is where you actually learn what's going on. So here's what's actually happening. President Trump is bringing back major tariffs. That means extra taxes on goods coming into the US from other countries. And China is getting hit the hardest. Some Chinese imports are now facing tariffs as high as 245%, the most aggressive move in the current trade war. That number isn't random. It's a combination of a 125% reciprocal tariff, a 20% fentanyl tariff, and additional Section 311 tariffs that range from 7.5% to 100%. When these are stacked together, some goods face a total rate of 245%. This sharp increase is part of Trump's broader plan to bring manufacturing back to the US and reduce our dependence on China, especially in industries like semiconductors and rare earth minerals. The tariffs are also a direct response to China's latest actions. In retaliation, China has raised its own tariffs on U.S. goods and moved to restrict the export of key rare earth metals, materials that are essential for building electronics, electric vehicles, military equipment, and more. These rare earths are a huge deal. They're used in smartphones, drones, power tools, computers, wind turbines, medical devices, and defense systems. Cutting off access to them could seriously impact American industries and even national security. Trump's team launched a new national security investigation into the supply chain threat, and more trade measures may be coming soon, including potential new tariffs on Chinese semiconductors. So, if you're buying things like electronics, appliances, clothing, or even groceries, expect those prices to rise, and for American businesses that rely on Chinese materials or parts, production costs could jump fast. That's why Powell and the Federal Reserve are watching this so closely. When prices go up and the economy starts to cool off, it creates the exact kind of storm they're worried about. And that's what we'll get into next. For regular Americans, this could show up as higher prices on almost everything, while wages stall, hiring slows down, and businesses start cutting back. Your dollar doesn't go as far, and your job security might feel a little more shaky. This isn't just a trade policy debate. It's something that could impact your daily life. And if confidence drops, in the markets, in the economy, or even just at the grocery store, it can snowball fast. That's when we start seeing real financial stress, both on Wall Street and in everyday homes. So you might be asking, how are investors reacting to all of this? Well, not well. Since the announcement of the tariffs, we've seen sharp drops in the stock market. The Dow, S&P 500, and NASDAQ all took hits, with tech and manufacturing stocks leading the way down. Companies that rely on Chinese parts or global supply chains are especially vulnerable. Even Nvidia, one of the biggest tech giants, saw its stock dip after export restrictions and semiconductor tensions ramped up. Investors are pulling money out of risky assets and turning to things like gold, bonds, and cash, which are typically seen as safer in times of uncertainty. And it's not just stocks. Big firms like Bank of America just released reports showing investor confidence is near a 30-year low. Fund managers are bracing for what they call stagflation risk, the exact situation Powell warned about. The markets are nervous and volatile, Wall Street is bracing for impact, and everyday investors are starting to feel it in their retirement accounts. Investor sentiment right now is in a rough place. According to a new Bank of America survey, confidence among fund managers is the lowest it's been in over 30 years. These are the people who manage billions of dollars, and most of them aren't optimistic. The top concern? A mix of inflation, economic slowdown, and a Federal Reserve that may not have any good moves left to make. In fact, nearly 90% of those surveyed said they expect stagflation to hit within the next 12 months. That means higher prices, weak growth, and more pressure on the average consumer, the exact challenging scenario Powell warned about. This kind of fear isn't just a headline. It affects how capital flows. When investors pull back, businesses borrow less, hire less, and expand slower. Markets tighten. And when that happens across multiple industries at the same time, you start to feel it in the real economy, not just the markets. The ripple effect can hit everything from mortgage rates to credit card interest. Banks get more cautious, employers freeze hiring, consumers spend less, and just like that, confidence drops further, and the cycle gets even harder to reverse. The bottom line? This isn't just about a few red days on the stock chart. It's about a shift in the mindset of the people who help fuel the economy. And when their outlook turns bearish, history shows things tend to follow. Now, let's zoom out. This isn't just a US problem. What we're seeing right now is a major shift in global trade, and it's happening fast. US-China merchandise trade has dropped off a cliff. According to recent data, trade between the two countries is down nearly 80% year over year. That's not a dip. That's a decoupling. For decades, the US and China have been tightly linked, the world's two largest economies, trading everything from electronics to auto parts. But now, with tariffs on both sides, national security concerns, and rising geopolitical tension, that relationship is fracturing. And it's not just about economics, it's about control, leverage, and long-term power. China is leaning into new partnerships with countries like Russia, Brazil, and others in the BRICS bloc. Meanwhile, the US is pushing to reshore manufacturing and build new supply chains through allies like India, Mexico, and Southeast Asia. That sounds good on paper, but pulling apart a global trade system that took decades to build doesn't happen overnight. And in the short term, this kind of disruption adds friction, raises costs, and creates uncertainty. If you're a business owner who depends on international suppliers, you're already feeling it. Delays, higher prices, fewer options. And if you're a consumer, you're paying more for everything, from phones to furniture. This is what decoupling looks like in real time. Long term, this could redefine how the global economy works. But in the short term, the transition is messy, and the growing gap between the US and China isn't just economic, it's strategic. So what does all this mean for you? It means now is the time to pay attention. Watch your spending, look at your investments, stay informed. Because in times like this, being unaware is the most expensive mistake you can make. We're going to keep breaking this all down simply, clearly, and without the noise. So if you haven't already, make sure you subscribe and tap the bell. This is where you actually learn what's going on and how to prepare for whatever comes next. See you in the next one.